Hey friends, our next president here in the United States will be Trump. And so what does this mean for my investing strategy, for my dividend stocks? Largely, it means business as normal. I like to buy the highest quality stocks that pay me dividend checks while I sleep, and these companies tend to do well no matter who is in office. That being said, this election in particular is probably one of the more significant ones of my lifetime. And I do see some changes ahead for our country that will probably change my investing strategy just a little bit. I want to share in the video today 4 strategic imperatives that will define my dividend stock investing strategy as we go forward, because these 4 strategic imperatives, they're going to set me up for the most possible success with Trump being the president of the United States again. And so I want to start with imperative number 1. As you can see on the screen right now, strategic imperative 1 is to grow my stream of dividend income. You know, this has already been my operational strategy as is. As I get closer to financial independence, retire early, I am going after dividend income, especially higher yielding dividend stocks. I want to focus on the highest quality dividend stocks that also happen to be undervalued and mispriced by the market and tend to be yielding higher. I especially, though, right now want to buy such dividend stocks that have added pressure on them because of perceived risks from the new administration. Let me take a step back. The headlines today. The stock market is up. It surged. We know that happened in the stock market at an aggregate level. But did you know I actually have stocks in my portfolio that went down today? Some of them, not a little amount. They actually went down a good amount. Not all of them. I have certain stocks that surged in value, but the market, it's starting to reprice risk. It's starting to reprice different stocks. When I see high quality dividend stocks go down, I love this because the lower the stock price, the higher my starting yield. And so as you can see on the screen in front of you right now, I think there are certain stocks that are mispriced by the market, undervalued by the market. They provide huge cash flow that furthers my goals. And I want to share just a few examples. So the first example is Pfizer. The starting dividend yield right now is 6.14%. I actually just bought Pfizer a few days ago. My patrons already know this. I'll link to my Patreon in the pinned comment below. But Pfizer stock was down today. It was down today, which pushes the starting yield up. It's up from 6% just a few days ago to 6.14%. If this stock stays at current levels or trends down from here, I could see this one being in regular rotation for me. Here's the deal. President Trump gets reelected, and why is Pfizer stock down? Well, I'll tell you, my personal hypothesis is it's because RFK Jr. is on his team. And what RFK Jr. wants to do is he wants to overhaul health and wellness in the United States. And I think some skeptics out there or some traders, investors in the stock market are pricing more risk into Pfizer because they may have the fear that RFK Jr. may be auditing, looking at big pharma, looking at Pfizer in particular. Personally speaking, I knew going into this stock that there were risks. With any stock that is trading at value levels, there are always some elements of risks. But I believed that they could overcome the risk, and I still do believe that. In particular, I am really encouraged by the results in their oncology division. I just did a video, I'll link to it in the pinned comment below, that covered Pfizer in a bit of depth. But long story short, a strategic theme of mine is going after these stocks that are offering strong yield that are a bit mispriced or value priced, and maybe even more value priced because of what's ahead for the political scene in the United States. But let's keep going. As you can see on the screen in front of you right now, I have another example of this strategic theme. The second example, and I love this one even more than Pfizer because I've been waiting for this. Realty Income, ticker O, right now, it's about 4.8% of my portfolio and 6.7% of my total dividend income. I'd like it to be bigger. The reason for a while here I haven't been buying is it had gone up in share price, but now it's been trending down. It trended down even more today. Now the starting yield is at 5.5%. If it gets just a little lower here, it's at about, right now, I think 57. If it gets down to 55 or lower, I'm going to start buying again. I'm really excited about this one. So Trump being all about real estate, why would the REITs drop today? Because it wasn't only Realty Income. A lot of REITs dropped today, and it was on the news of Trump winning the election. I don't know for certain why they dropped all of them, but I have a hypothesis. And my hypothesis is it really comes down to the cost of capital and the cost of financing. And today, the 10-year Treasury yields went up a little bit more. It's been on a run, actually, the yields for a while here. But I think the bond market is already pricing in the fact that President Trump will probably be spending a lot of money. There will probably be a lot added to our national debt. Obviously, this would have happened under any other administration, including Harris as well. So I don't kind of know why the market readjusted so much today, but I think traders, investors right now, they're pricing it in. I think they believe that REITs should drop in price, or at least they did today, because the cost of financing is going to be higher because we live in inflationary times. And maybe part of this ties into President Trump's tariff policy as well, with these tariffs, that if they could potentially, I've been reading reports that economists believe they could be adding to inflation. And again, if inflation is high, rates and the cost of financing are going to stay high, and REIT prices go down. I love this. And so I'm a contrarian investor. When I see things like this, it just makes me smile. Finally, Realty Income is back on my watch list / buy list, and it has a juicy 5.5% starting yield. It's not a qualified dividend. It's a REIT, and so it's taxed as ordinary income and return of capital. They'll spell it out on the tax statements each year. But I'm excited to have that one in the buy list again. And so that's strategic imperative number one. I'm sure you all get it. It's kind of business as normal, but again, it's getting me closer to FIRE and kind of just going after those opportunities that are appearing now because of how our world is changing. By the way, this video is not meant to be a political commentary. Yes, I did vote, and I have political beliefs, but I just try to keep them out of this. I'm just looking pragmatically what could happen going forward with this new administration. Anyway, let's go on to imperative 2. Check it out on the screen in front of you right now. So this one in particular is very important to me given the structure of my portfolio. I want to diversify my stock portfolio in a way that hedges my risk. There may be new risks that had not been top of mind for me for a while, or really to date. And this goes back again to make America healthy again. This is a great idea. We all want to be healthy. We want a healthy society. Good stuff. However, this could impact me as an investor. And so check it out on the screen. Let's just look at my portfolio. As you can see on the screen, my portfolio, the top 3 categories are sin stocks, restaurants. And when I say restaurants, I'm talking about fast food, and CPG food. And when I say CPG food, I'm talking about savory, salty snacks mainly, and carbonated sodas. Anyway, you add those up. I've got 44% of my portfolio by value and 52.8% of my portfolio by dividend income. I have a lot of weight on those very food companies and vices, if you will, that RFK Jr. may be trying through the FDA to change and to improve over time. And I think this is a very noble effort, a good effort. I think America should be healthier. I think this is a great idea for the future generations, for the kids. But when I just look at it pragmatically as an investor, could there be things that come into play here that cost the companies I own more money? And if the companies I own it becomes more expensive to operate, maybe because they're using higher quality ingredients, or maybe they have more regulatory oversight from the FDA. If these types of things are happening, can they pass that along to the consumer in price increases? Probably they can, because I think that's what the bond market is pricing in. But time will tell. And so as you can see on the screen in front of you right now, because of my concentration in those types of categories, diversification right now for me is top of mind. And so I want to go ahead and buy stocks, buy categories of stocks that, of course, are offering solid yield, because that's just where I'm at in my journey. I need yield now. I want it right now. I'm getting closer and closer, and I don't want to wait. So I buy the higher yielders. I get closer to fire faster. But anyway, Chevron is a perfect example. I'd love to buy more Chevron. Right now, energy in general in my portfolio, it's underweight. It's only 3.5% of my dividends, only 2.8% of the portfolio. I would love to buy more energy, double, triple, quadruple the size of my energy holdings. And again, going back to the political theme, President Trump's administration is likely to be very bullish for oil, for the oil industry. And so when I think about that right now, at this moment in time, Chevron, it's rallied. It was one of the stocks that went up a lot today. That being said, it's still on my buy list. It's still in that strategic buy range. And I just hope it doesn't run up too quickly. But this is one of those stocks that I don't think I'm going to have a buying opportunity for too much longer, but I really hope I will. But let's keep going. As you can see on the screen in front of you right now, I have more examples. So another example would be SCHD. Yes, the starting yield is a little lower at 3.37%, but it is justified because of the 12% dividend growth per year on average over the last 5 years. I'm underweight ETFs in general. ETFs as a percentage of my portfolio is only like 1.5% of my entire portfolio by value and by dividends. I'd love to add more ETFs. What I love about SCHD is it only has about 30% overlap with my existing holdings. And so it gives me broad diversification, including into financials where I have next to no allocation. In fact, financials in my portfolio are only 1.6% of value, 2.3% of dividends. Financials were surging today. The financials I do own I was like, wow, they're surging under the news of President Trump's election. And so anyway, SCHD is a no-brainer for me. That is one that I will keep adding. I already have been adding. Another one is DIVO. DIVO is an ETF that I covered on my channel a while back. Some of my subscribers and patrons brought this one to my attention. I am so thankful for that. I will link to the video review of that one in the pinned comment below. I will link also to other videos in the pinned comment below. I always try in my videos to have a lengthy description, to have helpful timestamps, to have helpful links in the pinned comment as well. So check all of that out. But the reason I like DIVO is it has a high starting yield. It offers me exposure to tech stocks. One of the segments of stocks that was rallying today were the tech stocks. I don't have a lot of exposure to tech stocks. I can get that through DIVO, and I can still get my yield because they're writing strategic covered calls. I think with Elon Musk, possibly here as part of Trump's team, boy, that could add a lot of value and a lot of kind of focus on technology in our country overall. And so that's probably a spot in my portfolio where I'm just under allocated and I need to do something about it. I think for me, I can't just buy the tech stocks because the yields are next to nothing and it just doesn't align strategically with where I'm trying to go from a cash flow standpoint. My solution for that is, as you can see on the screen, DIVO. DIVO has that beautiful 4.44% starting yield because of the covered call strategy, which I also lack exposure to. I'd say, as you can see on the screen, Realty Income, it also falls into this bucket. I'd love to have more REIT exposure. As mentioned, real estate I own outside of this portfolio, but I'm talking in terms of REITs, only 4.8% of the portfolio by value, and that's Realty Income. So I already talked about that, but strategically, I'd love to add that as a way to diversify risk away from CPG food, fast food, and sin stocks. Also, I would say right now, especially if we see higher rates kind of persisting, which I think the bond market is telling us, I could go for an income factory style closed-end fund. I could definitely see that in my future as well. But before I go all the way there, for me, I could probably see myself adding DIVO first, initiating a position there in that ETF. That's imperative too. You can see a lot of this is business as normal, but now there's nuances in there that reflect the political landscape and what's happening in the country. And I'm working strategically to align my portfolio with where I believe it's going to have the most success. Let's keep going though. As you can see on the screen in front of you right now, the third imperative that I want to share today is actively just watching for opportunities in high quality core dividend stocks. I have certain core stocks that may fall in share price due to changes in government policy. Right now, a lot of these core stocks, they're just not yielding enough for me to buy because of where I'm at in my journey, but I kind of want to buy them. A perfect example is RTX, which also has ticker RTX. It used to be called Raytheon Technologies. Starting yield is 2.1%. I'm not buying any stocks right now with a starting yield at 2.1%. Maybe I would if I were back in my 20s or 30s, but now where I'm at in my 40s, I'm closer to fire. It just doesn't add enough cash flow that I can use to pay the bills. But here's the deal. I am very hopeful under a presidency with Trump that we will see more peaceful times around the globe. I do believe that President Trump will be hopefully a peacemaker, and he will find ways to stop wars that are happening in our world. At least that is one of his campaign promises. And so I think we should all watch and see what he can do against those goals and against those campaign promises. Anyway, if that all happens, RTX stock being a defense company, it will go down. And this is great because, again, as a dividend investor, I want to buy this core stock when it's on sale. I want to buy it when it's trended down in price. And as you can see on the screen right now, again, right now it's trading at a lofty level. It's trading with a starting yield of only 2.1%. And so if it gets to a 3% starting yield or higher, you could probably see me adding to my RTX. And I really hope this plays out because I am all for global peace. Okay, another example is Johnson & Johnson. Honestly, I'm comfortable buying at these levels at a 3.14% starting yield, but maybe the starting yield will go even higher. I think with RFK Jr. looking at health, make America healthy again, he's going to be looking at pharmaceutical companies. He's going to be looking at food companies, and maybe there could be new regulations. Maybe there could be new ways of doing business that just put a little pressure short term on these types of companies. If that is the case, boy, could there be a buying opportunity in this core stock in Johnson & Johnson, one of my favorite core stocks of all time. I hope so. And so that's my imperative number 3. I'm going to be looking out there. Given what's happening politically speaking, are there going to be some really sweet buying opportunities possibly in some of my favorite stocks that are not selling necessarily at deep discount or even discount right now? Although Johnson & Johnson, honestly, I feel good about where it's trading now, but I'd like to see it a little bit lower. Okay, strategic imperative number 4. Check it out on the screen in front of you right now. The strategic imperative number 4 is pretty easy. Stay long in high quality dividend stocks. I believe this is under Trump. If Harris had been elected, same thing. I believe we are in inflationary times. There's going to be a lot added to our national debt forecasted over the next 4 years and probably beyond. Stocks, especially high quality dividend stocks, they have proven time and time again to be a great hedge against inflation. I want to be in the highest quality stocks in a well-diversified manner as a hedge against inflation. So there you have it. Those are the 4 imperatives, how I'm looking at investing right now going forward under Trump's presidency. Let me know in the comments below what you think about that. And if you are adjusting your strategy at all to reflect what is ahead here in the United States, I'd love to know. And if you enjoyed the video today, please go ahead and click the like button. It means the world to me. And of course, don't forget to subscribe. I have new videos on the way all the time. And I just want to thank all of you who take the time to comment in the comments section below. I try to go through all those comments, and if I don't respond to you, I'm still looking at your comments. So thank you for taking the time, but I try to respond to most of them these days. Before I go today, in terms of a full disclosure, I am long the stocks and ETFs mentioned today. I am long Pfizer, ticker PFE, Realty Income, ticker O. I am long Chevron, ticker CVX, and RTX, ticker RTX. I am also long Johnson & Johnson, ticker J&J, and I am long the ETF SCHD. I also plan to initiate a position in the ETF DIVO, DIVO. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. I'm just sharing my journey for fun. All right, everyone. Thank you for watching today. I'll see you in the comments below, and I'll see you in the next Dividend Stock Investing video.